Welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for today's show. Today's date is Friday, December 8th, 2023. I guess most of November, we've been trying to get long the market. Going into the holiday shopping season, right after earnings of a lot of the retailers that all gave decent numbers and decent forecasts, saying the economy's slowing a little bit. But this, as a matter of fact, just today, we've gotten some jobs numbers that still look extremely strong. So the consumer so far has been strong. We did have the automaker strike and everything kind of filtering through the system from that, which probably helps out with a few of the jobs numbers. But we're going into a big Fed meeting next week. And if we look at the Fed Watch tool, which I'll bring up here in just a little bit, we'll see that the futures market is really looking for a rate cut. And as early as March, right now they're saying there's about a 50-50 chance in March that rates will either stay the same or be cut by a quarter of a point. So showing a strong market. So to me, this is a real tough number in that unemployment is still staying low. Wages are still increasing a little bit. Like the consumer, the earner is strong and might be a little bit too strong. So next week's going to be a real interesting week. So going into the Fed meeting, we're going to have CPI and PPI. And if we can see inflation continue to go down with those numbers going into that meeting, they should get that data before the meeting, and we still have this strong employment market, that's a good sign for the market. Now, everything else reverses. If we are seeing inflation starting to creep up, which these numbers in the jobs market, I mean, I guess it's not anticipated that they're supposed to be increasing in the inflation. At least the pundits are not anticipating that. But if it does happen, that could be a shock to the market next week. So we've been getting bullish every Monday. Well, last week we got bullish on Friday going into the weekend. And we did a little bit of a different trade. We did a skip strike butterfly, went into great detail on Wednesday's Options Guide TV. That would have been the 6th. And talked a lot about what makes up a skip strike butterfly and the pricing of it. So we'll use them more often. And I think the rationale in my mind behind it is that is a trade that I will be interested in doing as we see the SPX hit 4,600 today. When we hit the 4,500, that was the first time. It took a while to get back to that level. So very interesting to see where that the SPX has now hit another round number, if you will. And on the way up, I kind of like to do this strategy. So I'm probably going to do a little bit more skip strike butterflies if the market stays strong. It's always a big if. Never really know until Monday or Tuesday of the week which way we really want to go with this market. The theme has been so far that we want to be bullish. We've done a couple of speculative long call spreads going into Black Friday and after Black Friday. Actually, I think we did 2 in a row of the long call spreads that were 1 week long, which to me, it's an alternative. When I'm looking at speculative trades that are based off of a market feel or something that we've seen in the chart or just in general, what the sentiment of the market is. The trades that I like to go between is a long call spread. And if it goes against me, roll that into a butterfly. Sell a short call spread to make the butterfly. Other ways on skip strike butterflies is to start off with, well, and I talked about this a lot on Wednesday, so I'm not going to go into too much detail, so you can go back and review the tape. But selling a short spread. But I'd like to do it in things like the SPX. You can get a decent credit for that short call spread, and then we're going to use that to pay for a butterfly. So that ends up being a skip strike butterfly. done for a small net credit. I'm going to show you that in just a second. And then we're going to continue to add to the paper trade portfolio. The stocks that we decided to get long on, we need to get long on a retailer. I think I want to wait just to see what happens. Well, it's kind of a catch-22. Do we want to get long going into the Fed meeting, or do we want to wait for the Fed meeting and maybe miss out? And the numbers, CPI and PPI, which I think is more important than the Fed meeting at this point in time. Right now, the Fed meeting is pretty much baked in that nothing's going to happen. So everybody's going to be leaning on the comments after the meeting on Chairman Powell and what the sentiment will be. Will he still be hawkish? Will he hint to that rate cut that the marketplace is hinting to? Interest rates on the 10-year have came down. 10-year and the 5-year trading fairly close to each other. So the skew between the short term and the long term is coming in, which is a good thing. Hence helps the scenario of a soft landing as far as the market is concerned. So yeah, very interesting week next week. So we'll start off. We'll get long something because it's not a show if we don't do a trade, right? So we'll figure out something that we want to do on Monday on a paper trading basis on Options Guide TV. But today, let's step back and let's first of all, I'm going to run to the options playbook. Let me get that strategy up that we're going to look at here. The good old skip strike butterfly with calls. Now, if we were with puts, we would be this entire graph would be flipped. So you could use this if you want to be bearish, but if we're bearish, we use puts. If we're bullish, we use calls. I know that's fairly intuitive, but you want to deal with out of the money option contracts, and that's what we're selling because we're targeting an upside. And the way this trade really works out is we put this trade on. This is the x-axis somewhere down here. We want the market to start going towards this strike B, which is right in the middle of strike B. We have half a day. We put the trade on. The trade was interesting to start with. We put it on for a small net credit of 60 cents. It's basically been profitable since the second that we put on. The market actually went down and then came back up. And that was an ideal scenario for a skip strike butterfly because the graph and the profit and loss is very weird in that you'd like the market to come on up and finish somewhere in here, but you don't want it to come up that fast. You want it to slowly come up to that range. Time decay is your friend if you're correct in a skip strike butterfly. And that's, I guess, the most important thing. So here's the options playbook. This is my book. Highlight it. We have all the different strategies highlighted. And now if we go to the FedWatch tool, so I want to show you this and start highlighting this a little bit more. I'm going to scroll down a little bit. It's showing you the actual countdown to the next FOMC meeting. And I'm going to scroll back up here. And right now I have highlighted the March session or the March expiration for these futures contracts. December 13th is the current one. So if I click on that, there's nothing, right? So current range is 525 by 550. That's where we're trading at. We go out to March. We see the current range is right here, 525 by 550. And it has moved a little bit. I actually, even since this morning. So it was about a 50-50 chance. So those numbers today has brought this probability down a little bit. So it's 45. We'll call it 55. We got some extraneous numbers. Obviously, these need to all add to 1 or 100 because something has to happen. So there's a 100% chance that something's going to happen, either one of these scenarios that is in here. So yeah, it was about 50-50 and now it's down 45-70, 51. And I can only, obviously it's because of the job numbers. It's pretty straightforward that we had a very strong jobs market and that has changed this probability a little bit. And I think that it, going into the meeting that if I had my path of least resistance, I think that this might come down a little bit more. Okay. So let's back out just for a second here and let's go and look at our skip strike butterfly that we did this week, our speculative trade. And I'm going to scroll up here just a little bit. Okay. So here is the trade. And I'm, I can look, I guess we can look at it in the options grid here on the TradeHawk software. So this is a live portfolio. It's a test portfolio. We have bought the 4640, sold 2 of the 4650, bought 1 of the 4670s. We can't use the SPX, which is one of my favorite trading vehicles, honestly. You cannot get those quotes inside the paper trading portfolio of the TradeHawk software, which is awesome, by the way. It shows you if you ever want to come and test out the TradeHawk software, you can do it for free. Look at the paper trading portfolio and play around. It's exactly like the normal portfolio, except you don't get quotes on a lot of the major indexes. And that's mainly because as a brokerage firm, you have to pay for those quotes on indexes that are proprietary to that index. So I don't know when that's going to change, but it needs to. Okay, so 4640, 4650, 4675. We bought 1, sold 2, bought 1, 1 by 2 by 1 down here in the order ticket. And you notice that this is laid out very well in this grid, in that if it was a standard butterfly, we would have bought the 4660. That would have been the strike that we bought at that point in time. And we skip that, hence the name skip strike butterfly, and we buy the 4670. That embeds a short spread, brings in a credit. That credit then pays for the butterfly. At least that's the goal. And hence we have a what if chart that looks like this. And I'm going to grab that. This is where the market is at. And I'm going to grab it and I'm going to zoom in. Okay. So this is as of today. We did it on Friday. So 1 week ago, 7 calendar days. And when we put it in on Friday, we did it for a net credit of 60 cents. So we did our short spread. We probably would have brought in, I don't know, let's say about $1.20 or $1.30, just from my experience of just doing a short call spread. The strikes that we skipped, the 4660 and the 4670. So we bring in less of a credit, but we now have an out. It's a trade that you can kind of put on and watch, and you have to understand that time decay is your friend. The one thing you just don't want to happen is that you don't want it to come flying all the way through here. So interesting enough, I guess I'll run back and show this real quick, is that you can get this done right now for a net debit of 7 cents to the account. So you're paying, well, actually it's at the midpoint right now if we look at that. So I'm seeing the bid is minus 10 cent credit. The midpoint is right at even, and even it would be the vernacular we would use if we were entering this to the trading floor. As a matter of fact, I'll just highlight that by clicking on that down. That's what I would put. Instead of putting 0 in a net debit or credit, you just put even into the order ticket. And the ask is 10. So it's 10 cents equidistance on the market. Midpoint is 0. So you could actually put this trade on today. It would be interesting to look at it and see what happens. If we do get that move up from 45.90 all the way up to 46.40, well, then you could get paid out on this. You put it on for 0, you're going to have a $1,000 requirement. And if it goes down, oh well, you put it on for 0. If it goes up, you have a possibility that it could land somewhere in this range. And you have half a day to do this because we are in December 8th, right? Just want to double check that. And that is today's date. So here's our expiration. You have half a day to do it. Here's what the what if calculator looks like right now. Market is over here, got a long ways to go, but you don't have a lot of risk. Now, if it does come within this range, now interesting in that this green line has to go to there, right? You got half a day of trading. So we put our trade on where it looks like we're going to make our 60 cents. We had at one point in time that I think we could have done it. We could have actually brought in more of a credit than just letting everything go worthless. The market is now trading right around even, so we could take it off right now, but there's no real reason to, because we have this hedge. We're at 45.90. We would love it to get to 46.40. Very rare chance that that is going to happen, but if it does, we're still profitable until we're not, which is about 46.55, right in this range. So interesting trade. It was it as far as pricing is concerned, everything, I guess it just reacted. If I were going to build a tape on how a skip strike butterfly would play out for the week, the only thing that would have been better is if we would have got to this range and we would have seen this green line move a little bit closer to the yellow line, which is at expiration. This is as of right now, and this is at expiration is right there. That was the only other scenario, but very interesting trade for the week. Talked about it a lot, so I'm just going to let it go. All right. So now Schwab and Charles Schwab in our paper trading portfolio, which I can't run over to right now. I can't do that. I think ultimately what I'm going to do is just grab a screen grab, because it's too much to log out and log back in. I already went through those trials and tribulations, and it didn't work very well to try to do it on a live show. And by the way, we are live here. So if you have any questions, please do throw them in the chat box, and I will try to address them at any point on the show. I would like to make this as interactive as possible. So on Schwab, we're at 64. Well, we actually were up a little bit today. And let's see if I can get that chart to come up fairly quickly. A lot of times when I'm running the video, I just move a little bit slower. Okay, so let's go right in here. All right, so today, yeah, we ran up. We almost got to 64 on this on today's candle. And 64, we're flirting with that. Guess what? That's where we sold our call at. So it's a real tough decision. And when I first looked at it this morning, that tail of the candle, it's being blocked by the blue trend line here. But the tail of the candle was right about there. Let me see if I do this. What is the high? The high is 63.84. Okay. If it gets to 64, I want to adjust it. I want to roll that trade. And we've really been flirting with it. And I'm trying to debate if I want to roll this going into the weekend or if I want to wait. And this is a kind of a tough call. We have one more week remaining in our short call option on Charles Schwab, which is a deep in the money option contract. That's a fig leaf position that we have on. I guess I should have preferenced that a little bit more. Inside the paper trading portfolio, we have a bunch of deep in the money calls that we've been selling call options against them. It's an alternative to a covered call. In the options playbook, we call it the fig leaf. And 63.84 is where that high is at. I think I might just I was thinking that I was going to roll this today. But at this point in time, with the market coming down a little bit, we got 50 cents away. If we go through the strike and it goes to 64.50 or it goes to 65, we're still okay. The closer we get to expiration, it makes it harder to do a roll. So today would be a good day to do it. Let's put it that way. But I'm glad to not have to. So I was thinking that I was going to roll this today, but this is a live marketplace. And honestly, I think I would wait. We got half a trading day today. If it got up to 64, maybe I would consider it. But you usually have about 50 cents. And let me highlight that. So let's back out a little bit. And we're going to go back and I'll make it about this, because that was going to be the kind of the trade for the day today. So let's go to the main stage here. And we will pull up the options playbook. So here's the section that inside the playbook, I don't have if I do go out and which is very possible now that I own all the rights to optionsplaybook.com, which is my website. It's very feasible that I may write another book. and I'm going to go a little bit. The next book would go deeper into managing options and talk about a lot of things that I actually do here on Options Guy TV, which is we're using live markets. We're trying to get a real reaction as to how the market might go. Now, we try to do it as a paper trade because we're trying to do everything live, right? We're trying to do the trades on the show. Sometimes I might be forced to adjust the paper trade outside of the show, but so far so good. And we're going to get deeper in our deep in the money call options. We're going to start adding to those positions too. The market is starting to rock and roll. We've just been doing one lots. I think we're going to bump that up and trade them a little high, and just trade larger lots inside the paper trading portfolio. Okay, managing positions, rolling a covered call right here. All right, so now you see it on your screen. You see the rolling a covered call. A big thing that I mention as you get down here is that take a loss. Well, it is important to note that every time you do roll, you do take a loss. So you are taking a loss on the call that you're buying, even though you're bringing in a net credit. And it's kind of like if you were playing blackjack, if you just keep doubling down, some people will have the theory that if you could just double down enough, eventually you're going to win. And that's kind of the theory of rolling calls. That's what you're doing. So you're taking a loss on the front month. You're selling a larger premium on the back month than that loss, and you're hoping that that back month option contract, that it doesn't get to that strike and you don't get assigned on it. Okay, raise the price to 95. Okay, so in this scenario, what we are saying is that you can't. Okay, this is always the analogy that I've used over many years of teaching options is you can't drive a car off a cliff and then take it to a body shop and say fix it, right? They're going to tell you it's totaled. Take it to the junkyard for parts and go buy a new car. That simple, and hopefully your insurance covers it. So in the scenario of rolling a covered call, if you let that stock get, well, a percentage basis would be all right, but I'm going to just use like in the Schwab scenario, if we get 4 points in the money on a $64 stock, that's like driving the car off the cliff. We let it get too deep in the money to be able to roll it, especially in the short time frames that we're using, and to be able to get it done for a net credit. We'd have to go way too far out in time to make it really feasible to do it. And honestly, if you let that get away from you, I'd probably just close out the trade and start over. But it makes it a real tough decision if you get 1, 2, even 3 points in the money. So you need to be preemptive in a lot of times. So right now we're 50 cents out of the money on a $63.50 stock. It's a real tough call because we got the weekend, and who knows if we gap open on Monday. There isn't any major news event that's going to happen necessarily on Monday. I guess we do have numbers coming out. But yeah, so that's the decision. And we're right at that precipice. All right. So by looking at the clock, that's going to be it for this edition of Options Guy TV. We didn't do anything to the paper trading portfolio. I was planning on it, but we did not do that. We're going to be adding to that position next week. We'll look at Monday, and we'll try to come up with a speculative trade, which we always like to do. And a lot of things about the speculative trade is trying to learn about pricing, taking the market conditions, grabbing one of the strategies inside the options playbook and applying it for that week. And please, if you are on YouTube, click subscribe, ring the bell, pound that thumbs up. It helps us quite a bit here on Options Guy TV. And we'll see you this Monday at 11 a.m. for the next edition of Options Guy TV. Thanks for coming, everyone.